This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro. I want to give a stock market update as of Friday morning. And obviously the futures are up this morning, so we're going to see if that can mount some kind of a rally here. We're testing the lows. As I've talked about, we've got a lot of bearish sentiment out there. So the potential for a rally is there. But let's go ahead and get into the nitty gritty, because I think we got a lot of important things taking place right now. I want to start this week with the volatility. I haven't brought this up mainly because if we look at it, so I use an average true range of the S&P using the SPX, and that's essentially saying over a 20-day period what the average point range is. And so right now we're trading around 167 points on average over the last 20 weeks. And if you notice, you see how that number has been climbing. Okay, that means volatility is going up. The size of each bar, including gaps, is increasing week by week. And that's been taking place since the beginning of the year. And if any of you have been watching my videos on this channel since the beginning of the year, you know that this started raising a pretty big red flag for me, because we were breaking the trend, losing the 18-week on this January 18th drop. But more important to me is the fact that the volatility was increasing, and times past, look at the times past where that has taken place and what it's done to the market. So it's not a small thing. It isn't a primary indicator for me. I always stick with price and momentum as my primary indicators, and I use this as a backdrop. The sentiment numbers are also a secondary indicator like this, but they tell me a lot about what the potential is. So if I know that if the price and the momentum don't look good, and I don't like the position of volatility and the sentiment, then I know we're in for something a little bit uglier. Whereas if the sentiment and the volatility don't look bad, and the trend and the momentum are showing signs or warning signs, that I'm thinking, okay, maybe we pull back. So I want to use these indicators, the volatility and the sentiment, to give me a little bit better idea of the severity of the potential decline. And I think obviously in this case, it gave a really nice heads up. So we are trending lower. And as I mentioned last week, we're oversold in the range. I mean, I can do this parallel channel again, just to make sure everyone's up to speed on it. We are down probably right near the lower end of the range, trying to break through, but the reality is we're down near this lower end of the range. So, I'm expecting some kind of a little bounce or rally, and watching the rally, I think, will tell us a lot. I did want to update you on the sentiment as well. The sentiment has gone from negative 13% to negative 16%. Now, it has gotten worse than that over the years, but usually when it gets really significantly worse than that, it's after a more prolonged decline. It's pretty rare to see it drop, to see the sentiment get this low this quickly. We're only 4 months off the high, and so I think if we go back to 2008, I mean, it had been going down for 9 months, 10 months, something like that, before it got to negative 25%. So just kind of keep that in mind. But again, we're short-term oversold and intermediate-term oversold. Good spot to look for a bounce. But let's go ahead and go through the individual time frames and see what we can learn from this. So we're breaking the 18-month. I mean, that's pretty clear that we're breaking the 18-month now. You see how we closed below it, and now we've had clear follow-through in the following month. So a break of a moving average for me is a close below it and then take out the low of the bar that closed below. Okay, that's what I would consider to be a true break of a moving average line. So this line is starting to roll over a little bit, although it's not officially flat, but it's put itself in a weakened position. The QQQ is definitely more pronounced in terms of the way it's rolled over. Now, if we go to the weekly chart, which I always consider to be the main time frame for me, because I'm not trading so much short term for just a couple days. If I were swing trading, my main time frame would be the daily chart, and the weekly chart would help support the daily, and the hourly would be more of a trigger, using the 10-minute to really fine tune the timing. Okay, I hope you guys are following me here. If you're trading off, if you want to swing trade for 2 to 10 days or something like that, your main time frame is your daily chart, and your trigger time frame is your hourly, and you use the 10-minute to help with the timing. The weekly at that point is just helping with the underlying trend and where support and resistance is. The monthly doesn't play as big a role in swing trading, but you don't want to fight it. Okay, if you're right at a declining 18-month, don't take a swing trade there. Okay, so but for me, because I don't swing trade for a couple days as much anymore, I don't have the time to do that. I am more inclined to look for my weekly daily setups and my monthly weekly setups. So the weekly is my main time frame, okay? And I'm talking about individual stocks, but also for the market and everything, just trying to get a gauge of what's really taking place. And, we can go back and look at how the weekly was the key time frame last year. You see how this 18 defined the trend, and now it appears it could be defining the trend again. The problem right now is we're down, we're clearly down in the trend, but we're oversold. We're getting stretched away from this moving average. Now, oversold is, you got to be careful about oversold. I don't just buy because we're getting stretched away from a moving average, okay? Because you oversold, you can keep getting more and more oversold. It's only a warning signal, okay? It is not a buy signal when you get stretched away. I think people like to dive in and get aggressive when you get stretched away from a moving average, but you need a sign of some kind of a reversal or buyers. Now, the most aggressive way to do that is to go down to the hourly chart from a weekly chart. So I'm looking at a weekly and I'm stretched away, and I'm saying, you know what, I don't want to wait for the daily to trigger because it'll take too long. I'm going to go down to the hourly. That's about as aggressive as you can get using the weekly chart getting stretched away. What I don't like about this setup is I've shown you the channel and the fact that we're oversold, but I don't like this and I don't like this. And one of the main things I don't like is the fact that this red DI is making a new high, right? That's the strength of the sellers, hit a new high with this low in price. So when I see that and I see the fact that the ADX is confirming and MACD confirming, I'm leaning more towards this being a rally that fails as opposed to a reversal. Okay, now I'm open to the idea that this could be an aggressive rally, and that it might change my mind if the volume is good and the velocity to the upside is good. But if I'm thinking ahead, and I always think like I'm a chess player when I'm looking at the market, I'm thinking ahead and I'm saying, I'm thinking that this rally is going to fail. That's where my head is right this second. Now, does that mean that's going to happen? No, but that's where I'm thinking. And I'm looking at this price break, and I'm looking at the moving average, and I'm thinking, I did the fib retracement stuff, right? Go do your fib retracement and look at where the zone is. And the zone's going to be somewhere in here as to where, the 382 and the 50% retracement will be really key. And I'll just throw this on here just so you can see. We always want to measure the last swing, and we want to know this is the zone, right? For the spider, it's around 415 to 423, 424. Okay, if we rally into that zone, which is where the 18 is, which is where that prior low is, right in that area, and we start to turn down on the hourly chart from there, that is a short setup, okay? Now, if we rally up strong enough to get to the 618, then you got to start thinking that we might pull back, but we're going to probably hold. So that's how I would handle this. I think I would be looking, this is, to me, if I'm looking at this as a short-term potential trade setup, I'm saying it's too late to sell, but it's too early to buy because we don't have a reversal. Okay. Now, if I wanted to play for a snapback rally, go back to my counter trend trading setup that I gave you not last Tuesday, but the Tuesday before that, a couple weeks ago. You can look for that in individual stocks. I don't think it really fits in here because we don't have any momentum divergence yet. But if you can find a leg to the downside on the weekly chart that's getting stretched away like this, that shows divergence on the daily chart, then you can play the hourly for a move back up to the 18-week. So that's how I would go about trying to play the next leg to the upside if it materializes. Now, I mean, if this rally that is shown in the futures right now gives it up, by noon today, then obviously we might not see this rally. But I'm inclined to think right now the high probability is that we want to retrace a little bit. The quality of that rally, how strong is that rally in both price and volume? Do we get vertical grid green bars, monster green bars from here with big volume? If you do, you're probably gonna take out the 18-week. The 18-day, which I want to make sure we spend a minute on here, obviously, because look, we failed here, and now we failed a third time in the vicinity of the 18-day. So it's pretty crystal clear to me what's driving this market right now, at least what's driving the trend, is the 18 on the daily chart. There's really not a lot to get bullish about as long as we are below a declining 18-day moving average. I want you to, my suggestion to you is that, we're trying to rally. You notice how bearish yesterday was, the last couple days have been, and yet we're not at a new low. So I want to see how this reaction is. We're trying to rally off this bottom. I mean, this could be a tested bottom. You see the difference between trying to rally from here. This is new low, and no test, that's just a single low. Now, if we rally, we have a tested low. We have two lows, okay? We have a much better chance of doing something more meaningful now, but there's nothing to get too excited about until we get through this 18-day moving average. The one thing I'll say is that this leg to the downside, if we compare this leg and this leg, right? So this leg here, we had momentum confirmation based on DI. See, the red DI hit a new low. And then on this leg, it did not. It did not confirm. So I've been starting to think, okay, is this really the start of some kind of a contraction where we can get a little bit more of a prolonged rally and break the 18-day? What's missing is we're not taking out the lows. So we're making lower highs, but we're not taking out the lows. You see how that? And we're not doing it on the bottom. We need this to make a higher high, and we need this to make a lower low. Use these DIs this way to give you more confirmation about when we're going to get some kind of a reversal pattern to take place. So right now we're keying on these two lines, and are they coming together? And this 18 MA here. And I think if you do that, you're going to see the reversal on the hourly. The hourly made a new strong new low, so anything is possible here. It could keep dropping, but you could also look at this as a climax, because you see how we had low ADX here on this bottom, and now we've made another test of this low with a big move. So this could be construed as a climax low, and we get a reversal that way. So just kind of keep that in mind. Don't jump to the conclusion that this is telling us we definitely have more downside. We have to stay open right now, and I think that the clearer way to look at this, because we're oversold in both of these trends, is the daily chart and the daily moving average and these green and red DI lines, okay? Keep those things in mind, and I think you'll stay on track and be on the right side of this for now. We're in a really, this is a tough spot right now. Most of the time you get a pretty clear, it doesn't take me very long to get to my point about where the market is, but right now we're in I think a really important juncture, a crucial juncture, and either we're going to slide away to the next support zone, or we're going to turn here and get a little bit better rally, probably back to the 18-week moving average. All right, keep those things in mind, and go ahead and post any questions or comments. Thanks.